Hey, good afternoon. It is Wednesday, September 28th, and this is a very, very important message that I want to share with all of our clients, people who are pre-qualified, pre-approved, and even real estate agents out there. What's going on in the market is something that no lender, realtor, economist has ever seen. Interest rates have gone up very quickly this year and in the last week. And one of the biggest differences that we've seen in this last week is because rates have moved so high, investors who buy mortgage bonds are holding on that investment. And so what does that do to you as the consumer? It makes your loan or your interest rate more expensive. Let me explain. So mortgage bonds and mortgage interest rates, here's how it works. Think of it like a CD. You have a CD at the bank, you give your money to the bank and they say, I'll pay you this amount of interest over a certain term, right? Like 2 years or 5 years. And it's a conservative investment because you're getting a guaranteed rate of return. It's very similar to when investors buy mortgage bonds. They're saying, here's my money, but I expect over the next 30 years for you to pay me a 5% rate of return. Well, what happens when we're in a market like this, when rates moved up so quick, so fast, is if I am saying, yes, here's my money for a 5% rate of return, but now the interest rates went to 7%, I'm losing money on that investment. So if I would have bought this at the beginning of the year, I'm losing money. The other thing is because rates are so high, there's a big refi threat to these investors. We all know that when the inflation rate starts to come down, we know one thing is that these interest rates will start to come down. It's just nobody knows when that's going to happen. It could be 2 years from now, it could be 3 years from now. So what the investors are saying is, if I'm going to lend you this money and buy this, invest in this mortgage bond, which means you get the loan, you're likely not going to pay that rate to them, the investor, for 30 years. You're likely going to refinance out of that rate in the short term. And so because of that, the investor who's buying the mortgage bond to lend you the money is now not making that interest over the next 30 years. So in order for them to still invest in this and it be a good decision, is they're going to charge you more up front to make it worth their while. So it's very tough to explain because normally you go to the bank, you write the mortgage loan and you think, oh, Chase is giving me the money. They're the ones giving me the money to buy this home. It's not how it works. Chase is actually getting their money from Fannie and Freddie or a pool of investors who buy mortgage bonds. It's just there's a middleman, which is the banks. And so if there's not an appetite to lend this money because the interest rates are so high and they know that you're going to refi out of it, they're going to have to charge you more up front. So the number one thing that you need to be doing right now is if you are making offers, make sure you get with your lender and get updated figures because your funds to close are likely going to include at least 2 discount points. Like that's the only option that's on the rate board. When you've got over 20 different rates, it used to be that the lowest rate, on the rate board, the bottom rate would at least would be a par or give you money back. Now, even this rate down here, it's still going to cost you money. And it's just a season. It's not like it's going to be like this forever, but I can understand as a consumer, you're thinking to yourself, is now still the time to buy? Well, what economists are still predicting, especially in this DFW area, is home prices, inventory is just we've increased inventory a bit, but builders are slowing down, and all the home sellers that have low interest rates likely aren't going to be selling their homes. Even if they want to buy, they're likely to turn that into a rental if they can find a way to do so. And so we're still going to have an inventory issue in DFW, and every 6.5 minutes, we have a family relocating here because of our jobs, our population, our no state income tax. So economists are predicting in DFW, home prices are still going to be very healthy. So a cost of a home yesterday is going to be cheaper than what it is tomorrow, period. The only good thing is that now you don't have to bring $100,000 over asking, waive all the contingencies. It's just the interest rate's higher, so your monthly payment's going to be higher, which might mean if you were looking at a Ferrari, your budget might now have changed to a Toyota. But is a Toyota still a better investment than taking a horse to work? Of course. And so the key is, especially if you're renting, get out of renting. If now's the time, you want to have that conversation, your lease is expiring soon, it makes a lot of sense. If you're currently a homeowner and you're sitting with a really good rate, it might not make sense. You might want to wait it out. But for those who have been sitting on the sidelines paying rent and couldn't compete these last 2 years because the market was so competitive, this is actually the market that you've been waiting for, even if it doesn't seem like it, because when these rates come down, we can always rewrite your mortgage loan for you with zero out of pocket and lower your interest rate. So that's why people say marry the home and date the rate. You're marrying the home because it's a commitment. You don't go into a marriage for just, a short period of time. You buy a home because you intend to keep it and live in it and be in it for 6, 7, 8, 9 years. Not the Britney Spears 72-hour wedding. Commit to the home, get that sales price as cheap as possible, and date the rate. We'll rewrite it for you when rates come down. So that's your Mortgage Nerd update. If you guys have any questions, please feel free to reach out to us. You know how to find us. Follow me on all things social, or you can schedule a phone appointment. Just click on the link and all my contact information is there. Thank you.